growth stocks in general trade at higher valuation multiples. They're more expensive than what we call value stocks, which are more sensitive to the economy. So what we've seen the last couple of years is that these growth stocks doing very well with interest rates falling. As rates are falling, you're using lower discount rates to discount the future cash flows of these companies, so you get higher fair values. But this shift 180 degree when the rates are going up.
Hi, it's ggoernert, Senior Investment Advisor at Canaccord Genuity Wealth Management and ggoernert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, once again, if you like my comments, please share, like, subscribe, make some suggestions of what you'd like to hear on the channel in the future. But today, really excited for the 2022 outlook for North American markets. So I'm going to be joined today by Martin Roberge, Canaccord Genuity's North American Strategist. Martin, how are you?
I'm good. Thank you, Greg.
Hey, I'm so glad that you joined us today. You did a fantastic presentation for our Global Outlook conference last Wednesday for clients, and I really want to take the opportunity to share it with those clients who hadn't had a chance to see the presentation, but also those who haven't yet joined us. So, walk us through. First, you had some calls on Canadian equities versus U.S. equities. Can you talk about that a little bit?
Yeah. As you know, it's a few years now that U.S. equities have outperformed Canadian equities. One of the primary reason for the outperformance has always been that the U.S. market is heavily weighted in what we call the growth stocks, like the Microsoft, like the FANG stocks, like the Facebook, Google, Amazon, and the likes. And the growth stocks in general trade at higher valuation multiples. They're more expensive than what we call value stocks, which are more sensitive to the economy. So what we've seen the last couple of years is that these growth stocks doing very well with interest rates falling. As rates are falling, you're using lower discount rates to discount the future cash flows of these companies, so you get higher fair values. But this shift 180 degree when the rates are going up, which is exactly what we've seen over the past few months. So we're going in reverse, and obviously the heavily weighted growth stocks in the U.S. market are now acting as a weight on the market over there, and we've started to see these stocks, underperforming the market, while outside the U.S., since we have lower weights or smaller weights in growth equities and more weights in value, the other side of the trade. Well, value stocks, like cyclical stocks, trade more with the economy, and when rates are rising, it means that the economy is obviously doing better, but there's also some inflation behind it. And value stocks give you exposure to growth and exposure to, like, it's a hedge against inflation in a sense. So these markets have done doing very well. And in Canada, since we are the market among G7 or G10 stock markets, where we have the greatest, the biggest amount or the greater number of value stocks, like financials, industrials, materials, and energy, account for 70% of the Canadian stock market. So we've got 70% benefiting from higher rates, and that's why we're seeing a strong rebound in the Canadian dollar and a strong rebound in the TSX as well. And just to finish on this Canadian tailwind, if you are a foreign investor and you look at Canada and you see the loonie going higher because of higher commodity prices, which we'll talk about, and also because we do better when rates are rising. You get not only what we call the currency return in your favor, okay, on your side, but also the price return from the index. And then you've got a dividend yield as well. So you get three tailwinds um, going for the Canadian stock market, which does well maybe 1 year out of four, and
Exactly.
2022 is likely to be that year.
Yeah, I mean, that's such a good point because it's very rare that we have a, if you're right here, and I think there's a good chance you are, with a rising Canadian dollar, you've got the dividend tax credit. So dividends you're getting paid out in Canadian dollars, and with a dividend tax credit, and if we have a rising currency or conversely a falling U.S. currency, that's going to bode well for our stocks here. Now, in some quarters, there seems to be some surprise that inflation is picking up. Now, that's not new to you and I, because we've been talking about this, and it's on the show many times for at least the past year about, at some point we're going to have inflation rise, and we're going to have some interest rate rises. And we actually talked about maybe a temper tantrum in the market, probably a year ago when rates rose. How are you seeing that playing out right now as far as impending, maybe more aggressive moves on the Fed?
Yeah. So just to give an overall picture, when we spend money on goods or services. It's been mostly goods.
Yeah.
Because as you know, because of the pandemic, services have been shut down.
So we've been stuck inside.
Demand for goods is like way above the historical average, and that's been fueled by like the absence of alternatives. Like if you have spare money, like where do you, like by default you gotta buy goods, and it's been also compounded by the checks or the various fiscal stimulus from the governments. So those two actions together inflated what we call a demand bubble for goods. And that's the first leg or first part of the inflation story. This is going to come down as we see supply chains improving. Like you're seeing China, for example, like stimulating their economy again, and obviously like more activity over there will allow more imports from North American companies. As you know, we're so dependent. But the COVID zero rule in China's hurt. But again, like with the government now trying to stimulate the economy, it feels like 2022 will be a year where Chinese imports in North America will be made easier. So that will solve the good inflation or the inflation on goods side of the story. It will bring the inflation down probably in the first half of this year.
Yeah.
The problem is that it will not go or decline low enough, because as we've seen this week, especially from U.S. banks, wage inflation is now creeping up. And Goldman Sachs, a 23% increase in operating costs. It's not only wages, but also IT, for example. But costs are rising across the curve. So wage inflation is a big chunk of aggregate inflation. And then you get the service. As the economy opens up, spending on services will go up. And these companies that have been like hurt quite badly will use their pricing power, to make up for the lost revenues of the previous 2 years. So you're going to see service price inflation picking up along with wage inflation. So you're going to see a reacceleration, and we're going to be moving away again from the central bank's target, like the 2%. Like, I don't think we're going to see 2% before the next recession. Yeah. So that will probably keep monetary policies around the world tighter than usual. And that's going to be the challenge for equity markets, because you're not going to be enjoying lower rates.
Yeah.
Okay? And the earnings growth will be the only lever. In the past, we had two levers: earnings growth and lower rates.
Yeah.
We got to forget about the lower rates. We've got only the one engine, earnings growth. that will be pushing the market. So that's why we have to be realistic and think about mid to high single digit returns from here.
Yeah.
But again, if you focus on high dividend yielders, maybe you can get a little more than the average TSX return.
Well, and that's a good point, because you pointed out that, this inflationary wave that's been created by all that money printing and everything that we've done so far has gone through the harder goods, and that's probably going to ebb. And I think your point was that you're probably seeing a deceleration of inflation in the first half of this year, but you're going to see a re-acceleration in the second half as that, it's kind of like dropping a pebble in a pond. As that wave goes out, it's going to move into the service sectors, which, as we all know, we haven't been able to travel, we haven't been able to go out to dinner and stuff like that. All that
theater,
that exactly is going to, and yeah.
So that's the service side, and again, in the consumption, but in the consumption basket, services account way more in the consumer price index and wage than good price inflation.
Yeah. Now, typically, when we get into a situation like this, when inflation starts rising, central banks around the world do what they've always done: they raise interest rates. But you've got a catch to that this time, because your premise is that we probably have a little bit more debt than we did, and I'm going to let you take it from there rather than me spoil the surprise.
Yeah. There's a limit to how high bond yields can go. As you know, consumers sometimes borrow using variable rates, not necessarily fixed. And as rates are moving up, let's think about mortgage rates. Not only the rates are moving, but the underlying assets, for example, have moved up as well. So for a house, your house will be costing more, not only because mortgage rates will be rising, but housing prices have been rising as well.
Exactly.
And wage inflation in the housing sector is rising because it's rising everywhere in every almost single industry.
Exactly. And it's not just inflation, but it's my background is economics, so it's inflation expectations that set the bar going forward.
Yeah. So rates will be rising to a level where eventually they could choke the economy or become a stabilizer. Like the big risk, Greg, and this is probably the key takeaway from our show today, is that the big risk out there is that central banks find out that they're lagging the inflation cycle too much, and they have to create an economic downturn to break inflation once for all. Okay. I'm not saying that they're going to go back to using the 80s methodologies or strategies, but what if they need deliberate rate, like force an economic slowdown through higher rates to break inflation, because they feel like they're never going to get it to 2.5.
Right.
So the rates will do it. There's a first part of the equation which is like higher rates in the market will moderate growth. And because we have so much debt, not only in Canada, but in the US, we looked at countries where in the past, total debt, like consumer, businesses, government debts in total, when they were around 250% of GDP, that's a lot of debt.
Mm-hmm.
A push above 2%, the economy would slow down because financial conditions tighten too rapidly. Like people are facing higher mortgage payments, auto loan payments, and it's a natural force. It's a natural headwind, okay, that when rates are rising, the economy moderates. So this is a situation when total debt is around 250. We are at almost 350.
Wow.
Total debt to GDP in Canada and in the US. So it doesn't take a genius to realize that if we really push much above 2%, there will be an issue in terms of servicing that debt. Okay, so this is the idea about countries experimenting a debt trap, and we're there among the G7 countries, and I would say like the DM countries, developed countries, are facing all those challenges going forward. So that's why eventually it will be the time for me and for you to increase or put some bonds in the portfolio, because there's a natural cap, which we
Yeah.
believe is around 225 on 10-year treasury bonds in North America.
Because right now you've got an overweight on commodities, you've got a market weight on equities, and you've got an underweight on bonds right now, correct?
Yeah, yeah,
Yeah.
that's the positioning right now.
Yeah. Now, the other thing you pointed out too is that you're seeing right now, probably going forward, that we're going to see higher bond yields, but a flatter curve as well.
Yeah, because of the debt trap will put a natural cap on
Yeah.
rates, while
But the problem is
obviously,
it gets closer. If you're not careful, you can invert that curve, which always
well,
causes a recession, right?
the short-term maturities, the short-term yields
Yeah.
will continue to go up as people realize that there's maybe more inflation, more persistent inflation in the
Exactly.
system. So the short-term maturities will go up, but the long have a longer view on the business cycle, and
Yeah.
those long bonds will stabilize, and eventually the short will narrow the gap, and that will flatten the
Yeah.
what we call the yield curve, which is just the differential between the long rates and the short rates. And eventually, this is a very important factor or predictor of business cycles. And when we invert, normally it's an indication that there's a recession risks.
Yeah.
But like Greg, we're not there. Okay?
No, I'm not saying we're nowhere close to there. I get that. I just wanted to point out, like, if you have a flattening curve, what might and the policy risk that might be there. Now, from that, the other piece that you put together was on the commodities front. You're bullish on commodities, and you talk about the restocking of China. And why don't we talk a little bit about that before we wrap it up here?
Yeah, demand, like there's the demand side, like just like oil, for example, which is a big chunk of the commodity basket. Oil is back to 100 million a day of demand. Okay, 100 million
Barrels a day, yeah.
barrels a day. This is where we were before the pandemic, and we're missing, according to our analysts at Canaccord, about 4 or 5 million barrel a day of commercial demand, like
Yeah.
transportation,
Jets,
air
transportation, trucking,
transportation.
all that stuff, yeah.
That's right. So demand is back to where we were before the pandemic, and on the on the supply side, producers are extremely disciplined because they're scared that the global pandemic will have several waves, which will eventually hurt demand. So they've seen this movie before in 2020, 2021. As a result, they are very prudent in when it comes to spending their money, or their how they grow their capex. So capex relative to company sales are very low. They've rarely been so low. And one of the reasons, because they are not increasing capex, is some of the oil producers have also too much debt on their
Yep.
balance sheet, so they cannot do it. And that means that in a stable demand environment, but still contracting supply, with a contracting supply backdrop, the demand supply equation is going to force oil higher, but also all commodities, because they are still always they are all facing the same stable demand backdrop, with demand back to where we were before the pandemic, but the supply response has not come yet. And this is unprecedented. Okay, this is unprecedented. We've never seen that.
And we've talked
No,
about
never.
that the past couple of times, that companies restocking had been sluggish and slow because you don't want to restock and get things together and then have another lockdown again. So this is
That's right.
exacerbated over time as well.
That's right.
Yeah.
So overall, then that's why Canada looks really good, because we are the index in the world with the biggest weight in commodity stocks or resource stocks, and these stocks are still below to where they were in 2011, 2012. so where they were 10 years ago. So they're, and companies are returning cash to
We've
their
seen it too.
shareholders as well.
Yeah. We've seen
So
dividend increases,
you
special
get
dividends happen. Yeah.
special dividends, buybacks,
Yep.
stock buybacks. So these are becoming utility-like companies, and we've got plenty of them in Canada. So if you want to have high dividend yielders or high free cash flow yielders in your portfolio, Canada is right on top of the list versus other markets. So I'm kind of pushing really hard for your clients to start taking a little bit of money out of the US
Yep.
and put it in the high dividend yielders that we have in Canada.
And that's such a good point because, I used to always make the case that, statistically, Canadians tend to be the biggest homers as far as investing in their own country throughout the years. And I usually try to get people away from that habit and to invest overseas because it's a bigger market. But this is probably the one time that happens once every, 8 to 10 years where this is probably the time, from what I'm hearing you say, that, no, this is the time we want to be at home.
Yeah, and again, like it doesn't change the fact that from a strategic point of view, and this is the key here, there's a difference between a strategic view and a tactical view.
Yeah.
The case for Canada is a tactical view. Like it's kind of a 12 month, 18 months point of view where you have to slightly increase your exposure in Canada. But from a strategic point of view, obviously, like you've got to have money a little bit everywhere in the world. And the problem over the last couple of years that, as you said, Greg, the home bias has been too big of a problem in Canadian-based investors' portfolio. We did a lot over the last 5 years to diversify away from Canada. That was the good thing to do. Now it's just a question of tactically bringing back some of that cash, because you're going to face lower returns in the U.S. and other markets because you're going to lose on the currency, and also these markets are like the U.S. is more expensive and more vulnerable to so let's say some challenges for the growth stocks, which are heavily weighted in this market, in the U.S. market.
Great comments. Why don't we leave it there? Martin Roberge, Canaccord Genuity, North American Strategist. Thank you, Martin.
All right.
Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.